All right, so we are making it through this chapter slowly but surely. So we've discussed briefly both deferrals and accruals. Let's look at some accruals here. We've got both examples of accrued revenue and accrued expense on this page. And so when we recognize, first looking at revenue, when we recognize that revenue has been earned, well, no journal entry was ever made. So this adjusting entry is something that we're going to do at the end of the period, and it looks a lot like a regular journal entry. You know, if we were to sell something on account, say for example, a plumber comes out to your house and does a lot of work, and you know, you make arrangements with the plumber in advance. Say, you know what, can you bill me for the services you provide? Well, he's going to set up an accounts receivable for you, and he would also have revenue. But that's not exactly what we're talking about here. What we're talking about here is a situation where we go through again and we say, okay, what services have we performed over a certain period of time that we have not made any kind of journal entry for, and now we need to record so that we get that revenue booked to the proper period, whether it's a month, year, whatever the case may be. So this particular adjusting entry can also be a fairly regular entry, and it would just simply be to debit accounts receivable, which is an asset, okay? And assets go up with a debit. Now, very difficult concept for students is, why is revenue a credit? Why does revenue go up with a credit? Well, let's say that these three X's represented $500. That means these three X's represent $500. Our debits and credits must equal. Therefore, if we can accept the fact that accounts receivable of $500 is a debit, then revenue is forced essentially into being a credit for the same $500. Accrued expenses, same exact story as before. No journal entry has been made. Think about those, the wages for the 5-day period that we discussed, December 27th through December the 31st. We have incurred those wages, and so we will recognize that expense in the month of December, even though we're going to pay it in the month of January, okay? But because we haven't paid it, we must set up a payable, a liability to pay those wages, because we might not pay those. Gosh, if it's a bi-weekly payroll that's 2 weeks behind, we may not actually pay that money out until about January the 23rd or so, right? So we must set up an expense, and we must set up a payable. Looking at both of these, look, what do we have? We said that adjusting entries always impact one balance sheet account and one income statement account. Here's our proof. Accounts receivable is a current asset. Revenue is an income statement account down here. The expense, wage expense in this case, is the income statement account, and accounts payable for wages, or salaries payable would be a better way to wages payable, salaries payable. I don't really like accounts payable for wages. Regardless, any payable is a liability account on the balance sheet. All right, looks like we've got some information about deferrals. It says a deferral occurs when cash related to a future revenue or expense has been initially recorded as a liability or an asset. So I want to go back to the previous slide, if I can. Yeah. The adjusting entry here is the only entry that's been made. So when we talk about deferrals, that's not what this says here. We have either recorded a liability up front, or we've recorded an asset up front. So let's see how this is different. It says if the cash received is related to future revenue, think about the rent expense or the rent revenue example that we had, it is initially recorded as a liability called unearned revenue. I think we also had an example in the prior chapter regarding the sale of season tickets. Okay, we get the money up front, but it's unearned revenue because we haven't played any games yet. All right, the adjusting entry in the period when the revenue is earned debits an unearned revenue account. And remember, unearned revenue is a liability, so it normally has a credit balance. We're going to debit it as the revenue is earned, and then we're going to credit the revenue account. We'll look at some examples if that's confusing. If the cash paid is related to a future expense, it is initially recorded as an asset called prepaid expense. Again, going back to our going back to our insurance example, we paid the $600, but no time has passed, so we have not used any of that insurance up. Therefore, we do not have any expense that we can recognize. We initially record that as an asset. Then as each month passes, right, we would credit this prepaid expense, insurance, prepaid insurance, and then we would debit insurance expense. In our example, $100 a month. Okay, I believe that's what it says there at the bottom. Yes. Okay, so here's an example for deferral similar to the one that we had for accruals, and you'll notice that there's some differences here. So when we talk about unearned revenue, again, this is revenue. We've received the money, but we haven't earned the money. So this is our initial journal entry right here. In our net solutions example, we received cash of $360, but that cash was unearned rent. We haven't done anything. We haven't provided any services, allowed somebody to use our land for any period of time. So we set up a liability called unearned revenue. In our example, it was $360. After 1 month's time, for example, the revenue, at least part of it, has been earned. And so our adjusting entry is to back out. See, we set unearned revenue up with a credit here. Now we're going to debit it. If we're doing it for the 1 month period, it would be for $120. And then we would say, okay, well, now we've actually earned some of this revenue, 1 month's worth. In our case, in our example, 1 month was $120. So we would have rent revenue. Then this is earned revenue of $120 here. Prepaid expenses, generally a little bit easier for students to grasp. Using our insurance example, what did we do when we paid for that insurance policy for the 6 months? What went down? Cash went down by $600. So we have a prepaid expense. In our example, it was prepaid insurance for $600. Cash, which is an asset, is decreased by $600. So we have one asset going up, one asset going down. Now, let's travel 1 month into the future. Our adjusting entry is, in our case, the actual insurance expense of $100, and we're going to credit the prepaid expense asset by $100. And so if we think about this, after 1 month's time, we would have the $100 expense on the income statement, but this prepaid expense over here was set up as $600. Yeah, let's see, $600 minus the $100 that we have used up. Now, if we were to look at our balance sheet after 1 month, this prepaid expense would only be $500, not $600. Okay? All right, so all we really have here is this is our unadjusted trial balance that we had for net solutions. We did this in the prior chapter, I believe. Yeah, and so some of these accounts are going to be subject to adjustment, others are not. You know, if we look through here, cash is not going to be adjusted, but accounts receivable may or may not be. Supplies, probably yes. Prepaid insurance, probably yes. Land, no way. Office equipment, absolutely not. Any liability account could be an adjustment. unearned rent, that's a liability. There could be an adjustment there. Common stock, dividends, these are not going to be affected. Fees earned may very well be affected because they relate to accounts receivable up here. Any type of expense item could also have an adjustment. Okay, so all we have here on this slide, this is just an expanded chart of accounts for Net Solutions. All of the accounts, you don't need to know these numbers here. Just notice that the numbers do get larger as we go from asset accounts into liabilities, stockholders' equity, revenue accounts, and expenses. All of these items in yellow that are highlighted in yellow, these represent new accounts that we have not previously dealt with. We've had all of these other accounts, so we've done quite a bit of work already, right? So over the next several slides, we're going to look at adjusting entries that impact these 5 accounts, okay? And then we're also going to look at what the impact would be if we did not make the adjusting entry. And that is very, very important because that's what ties this whole adjusting process together. Without looking at the impact of our error of not making adjusting entries, we can't, I mean, if you understand it, great, but if you don't understand it, that's what's going to hopefully tie it all together for you. All right, let's go ahead and wrap this video up, and we'll get started with some examples in the next video.